Yeah. I forgot. Always I forget to record the meetings. Okay. Regulating financial reporting. Regulations are required mainly due to, because regulations is required for many reasons. When it comes to reporting and limited liability companies, legal persons, the major requirement or the need really lies with the agency relationship, agent principal relationship. Wherever a tiny group of people are empowered and given some resources to act on behalf of others, then the agency is created. Agency is everywhere, right? Every agency is everywhere. So that is the reason why this reporting comes. But it has to be legally enforced, legally enforced. Therefore, for the discipline of financial accounting, we need to set boundaries first. In other words, our scope. That's what the conceptual framework is trying to do. When it comes to regulations, the conceptual framework is one part that creates or really formulates or sets the basic foundation. When the agency, as long as agent principal relationships exist, inevitably agency conflict arises. Therefore, what we call conflict of interests. Then you need to safeguard interest of everyone. There is a tendency and greater possibility that actions of actors or stakeholders may favor selected groups. When we take a limited liability company, there are different stakeholders, shareholders, or directors, managers, employees, suppliers, customers, government agencies, so maybe so many other different types of environmental and social groups, and general public likewise. The power is with the managers, yeah, lenders, yes, good. Someone, it's always just you're welcome if you can communicate and put some input, that would be really good. When you provide information, so who has the control at the end? The managers. Managers are given the power to carry out all these operations of this particular legal person. Under normal situations, even if you think of when one party, a tiny group of managers and directors, when they take decisions with the power that they have and the resources that they can access, will it be fair by everyone, or what would be the situation which is most likely to happen? You know that under normal sociology and psychology, also even economically, tendency is there that they might favor selected groups unless some established frameworks are there. That is the nature, since we live in a market economy. So that in order to, because if that happens, that's not good. Therefore, To safeguard the interest of everyone, you need regulations. To reduce the information asymmetry, I discussed a little bit about the information asymmetry. Yeah, 1 minute, and yeah, someone is just asking a question. As the need of regulating financial reporting, can we take that something to compare companies and industries? In fact, that is not a requirement of the regulatory framework. Just once we have the information, you can compare, contrast, and take decisions, of course. But mainly, objective is to the prime objective of a regulatory framework is not to do any other things, mainly, but to safeguard the interest of stakeholders, mainly connected to the agent principal relationships. But in that particular process, some other things also happen that could be used for decision making. For example, when auditors give you an audit report, based on the audit opinion, you may decide what to do, and just you can compare this company with another one. Of course, there would be outcomes, consequences are there, but that is not the very best purpose of doing this. Okay, so second one is reduce the information asymmetry. This also links with the agency principle. Asymmetry means not equal, not symmetrical, not equally accessible. Like under what you call, if you just talk about the democracy, all the stakeholders must be able to access to information about the company if it is really transparent and democratic. Shareholders, lenders, buyers, suppliers, employees, everyone, customers must know even what the production process. Assume that particular company manufactures a product, say technical product, iPhone, latest version, 500, 600,000, whatever. So assume that that is being sold at a price of 500,000 rupees. You may be using an iPhone. Do you know that how this 500, roughly, how this 500 rupees is distributed among different stakeholders and among those who really contributed to manufacture this good? You do not know, right? So you pay the price, but you don't know how the money, like the benefits, were divided among different parties. So likewise, when it comes to companies, so different stakeholders have different access. They do not know everything. It's not good. So that is why regulatory framework tries to provide at least basic information, but not all. Financial statements provide general information, but not all. In a fully democratic, what we call boisterous democracy, anybody must be able to access to any information freely. And based on information, you take decision. So since there is an information asymmetry, if you can reduce it, that's good for decision-making purposes. We share the information. Then regulatory framework helps to do that. Support decision-making process. So indirectly, yes, if we can access to information, if you know what's going on, if it is prepared based on given guidelines and all these things, framework, to some extent, you can rely, faithfulness of the information would increase. As a result, that could be used for decision making. Actually, decision making process improves just because of the quality or the enhancement of the quality of information that is provided in the financial statement. And to ensure the quality of, actually they are interconnected. So the quality, by ensuring the quality of information, it will help the decision making. When you, in order to support the decision making process in an objective manner, you need to reduce the information asymmetry if you can do all those things, finally, we can claim that no matter whether it really happens, we can claim that, yes, regulatory framework has safeguarded the interest of stakeholders. Now we will move on to the conceptual framework. Among different regulatory framework, conceptual framework creates the basic foundation. How can we understand a conceptual framework? There are different ways of understanding conceptual framework. Already you have learned. I'm sure that since you have taken first year accounting course, you have learned, you have some idea about a conceptual framework. I would like to define a conceptual framework like this. Conceptual framework is somewhat similar to a constitution of a country. That is the most easiest way of understanding a conceptual framework, because it's conceptually. Framework provides conceptual ideas, broad ideas, like in a case of constitution. Constitution talks about human rights, the freedom of speech. Likewise, there are so many things, including fundamental rights of humans. You need to spell them out one by one, what they are. When it comes to children, when it comes to women, when it comes to environment, society, judiciary, any other areas, finance, fiscal policies. Likewise, you can talk about, you can go on talking about these things, but those aspects should be aligned with the constitution. Yeah, employees, yes. Yes. These provide guidance, directions, of course. So I'll come to that one. Like first, think of like a constitution. Constitution tells you the basic guidelines in abstract form, conceptual form. So good example is the fundamental human rights. Then if you have a constitution which stipulated about the fundamental human rights, no government, no act can violate or contradict that basic right. That is the reason why most of the acts proposed by different governments are challenged by general public, saying that so there are contradiction with the constitution. Human rights, just recently enacted acts, if you just look at recently passed Finance Act, Colombo Port City Bill, to take this thing, the court specifically mentioned that yes, there were so many different sections, provisions which contradict the constitutions again. So it is not, so it does not go in harmony. Then such a system does not work properly. Actually, it is your responsibility. That means the government's responsibility to draft all those acts in line with the constitution to protect the interest of the general public, everyone, all the stakeholders. Now you can understand if the government has an ulterior motive of serving selected parties, like invested or their aides or known people who are within their networks of corruption and all, what happens? So always legal provisions will help selected group of people. So it's bad. Good example, if you take this recently enacted Finance Act, you can disclose your undisclosed wealth, income, and supplies. Assume that you have undisclosed wealth of 1 billion rupees, right? Undisclosed, but you have kept them, or you have used this 1 billion to buy an apartment in Australia. Now you come to Sri Lanka and make a disclosure saying that I have undisclosed wealth amounting to 1 billion rupees or whatever, and please release me. I would pay 1% tax. Then not pay. Then what next? What are you going to do with that 1 billion? According to the provisions given in this particular act, they have to use these undisclosed wealth, income, or supplies once they are disclosed only in 4 channels. If they can do that, if they can show that they have invested that money there, so they are safe. Number 1 is treasury bills, treasury bonds, corporate bonds, or treasury bills and treasury bonds 1, corporate bonds number 2, shares of a limited liability company number 3, and movable and immovable property. Then that person has an apartment in Australia with value of 1 billion rupees. What should that particular person do? You may ask a question. In what ways is it going to help Sri Lankan economy? No way. It will help. That person might say, yes, I have already disclosed. According to the provisions, I can invest it in property. Already I have bought a property. This is in property. My intention is to keep it in property. Definition in the property that in that particular act says property could be in Sri Lanka, in abroad, movable or immovable. Immovable property includes gold, jewelry, something like, so I can't remember the list. It goes on, including gold. So you see now, act, if you carefully study, helps only selected people. It doesn't help with the economy. It's bad. So anyway. Okay, I'll come to this point. So someone has asked a question. So therefore, conceptual framework is first similar to a constitution, like in a country. Therefore, all the acts should be, or any other legal requirement should be drafted and enacted in line with that constitution. If there are contradictions, that ruling of a country would be in a real mess. Same principle is applied to conceptual framework for financial reporting. So conceptual framework for financial reporting provides the basic guidelines for what? For financial reporting purposes. That is just to provide quality information for all the stakeholders. How do you do this thing? So to enable this thing, you need to have accounting standards. So that is why we have a separate act called Accounting and Auditing Standard Act. It is a part and parcel of the law of our country. So all those accounting standards are supposed to be prepared in accordance with the conceptual framework. Now you can understand how conceptual framework is linked to acts and how it can be compared with the constitution. Sometimes there may be, in case if some contradictions are there, they have to be explained very well and should be known. Otherwise, that context will not be smooth. So if you want to have very good financial reporting environment, of course, accounting standards should be prepared in that manner. Answering to the question, someone just asked, yeah, conceptual framework says primary users and of general purpose financial statement has present potential investors, lenders, so many things. So technically, here is the present and potential words apply only for investors, or is it apply for lenders and creditors as well? Yeah, actually, yeah, everyone. Basically, we'll go through like objective of conceptual frame, like objective of accounting, mainly when it comes to reporting. As I told you, practically there is a need that we need to provide general purpose information to all the stakeholders, but technically and legally, who provides finance to an entity are only the shareholders and lenders. So therefore, obligatory, the things have been prepared, keeping that thing in mind, equity holders and lenders. That is why the formal way conceptual framework is defined like the framework is a coherent system of interrelated objectives and fundamental that prescribes the nature, function, and limitation of reporting. It describes about the nature of reporting, functions of financial reporting, and limitation of financial reporting according to Financial Accounting Standard Board. Likewise, different conceptual frames are there. We will discuss. What does a conceptual framework do? Therefore, it provides basis of generating high quality financial reports. So recall what we talk about the purpose of a conceptual framework. Therefore, conceptual framework is something that serves that purpose. One of the purposes is to provide or ensure high quality information in the reports. Describe the basic concepts. So this is very important. Like these are the areas which link to a constitution of a country. Concepts that underlie the preparation and presentation of financial statements for external users. So that is why it is called conceptual framework. Concept deals with concepts, basic principles. It talks about then objectives of financial reporting. When we look at the conceptual framework for financial reporting, it explains its own objective, its own purposes. In addition, it explains the objective of financial reporting as well. Then how the objective of financial reporting can be achieved. There could be so many different things, but in a nutshell, keep it in your mind that the major objective of financial reporting can be achieved if you can ensure that high quality information is provided in simple terms, in day-to-day language, not in technical language. The quality can be assured. So if you can claim that the quality of information has been restored in the financial statement. That's the objective, nothing else. How do we improve the quality? By maintaining and protecting or ensuring that these characteristics are there. That is why we need to know about qualitative characteristics. Qualitative. ගුණාත්මක ලක්ෂණ. කියන්නේ මේක අවසානයේ අපි සාරාංශ කරලා ගත්තොත් conceptual framework එකකින් කරන්නේ accounting standards හදන්න, ක්‍රියාත්මක කරන්න, යොදවන්න අවශ්‍ය පරිසරයත් ඒකට අවශ්‍ය concepts ටිකක් හදලා දෙන එක. ඒ හදලා දෙනකොට උඩින්ම තියෙන ප්‍රධානම අරමුණ තමයි කොහොමද ඉහළ ගුණත්වයෙන් යුතු information දෙන්නේ, තොරතුරු දෙන්නේ. ඒ දෙන්න ඕන අපිට ජෙනරල් කියනවා high quality ඉහළ ගුණත්වයේ තොරතුරු තියෙනවා අපේ අරමුණ ඉෂ්ට වෙලා. ඒ නිසා තව දුරටත් conceptual framework එක කරනවා ඉන්නේ ඉහළ ගුණත්වයේ තියෙන දේවල් මෙන්න මේවා කියලා අපිට කියලා දෙනවා. ඒක තමයි qualitative characteristics කියලා කියන්නේ. So that is the reason why we need to learn about qualitative characteristics. Further, if you look at the structure of a conceptual framework, you may see the things that accounting standards should follow and preparers of financial statements should follow, readers of financial statements should understand, are aligned with three major areas. Number one is the definition. Actually, this like for example, assets, liabilities. Likewise, we talk about many. Definition matters. The other one is the recognition and measurement. Recognition and measurement. Even though they are two different things, they go hand in hand. You can't, measure without recognizing. There may be some items according to the definition cannot be recognized. For example, assets. Assets. Definition might tell you this would be an asset, but you would not be able to recognize due to some other reasons. So some of the abilities that the entity has, the skills of employees to some extent, would be an asset according to the definition, but you are not in a position to recognize it due to some others. So now you have to understand that it is not that easy to bring items into financial statements simply by fulfilling the definition. Then need to go for the recognition. Recognition is the real recording process in the books of accounts. Once you reach to the level of recording, how do you record? Without having values, numbers, you can't record. That is why I told you recognition and measurement go together hand in hand. And there is another aspect as well, that is the disclosure. Of course, if you are clear on definition, recognition, and measurement, so the same thing would be disclosed. So these are the major areas covered in a conceptual framework. I'm not going to talk about the objective of financial reporting. Already you have learned these things here. In summary, simply speaking, providing information, of course, to who? Existing and potential investors. Existing investors are the shareholders, owners. Potential investors are the whoever wants to invest in your company in the equity, lenders and other creditors. So this is how, as per the revised IASB, FASB framework, the common converge framework that is in use, this is what we are preparing. Objectively, we need to cater the needs of investors in equity and lenders. Not only the lenders, other creditors. So creditors in the sense, in an organization, there are some creditors, suppliers, who provide you operating leverage facilities. Supplier will provide you some, say, credit facilities or any other arrangement. So anyway, just let me share with you one very important point. Something just pop up in my mind when I talk about these creditors. 1 minute. I would like to share one corporate. Where is it? This is the thing. Do you see the screen? So what I share now? Corporate disclosure or related party transaction. Okay. This was yes, released yesterday by Nestle Lanka PLC. What does it say about? What has it been disclosed? A related party transaction. I'm not going to read out the entire related party transaction. So this related party transaction says that the Nestle Lanka PLC has taken a temporary borrowing of 26.6 million US dollars from its sister company, that is Nestle Treasury Center Middle East and Africa Limited, related party transaction. So what is the significance of this particular transaction at this point in time? So in a way, this facility has been not given by an outside lender. It has been arranged by your related party just to do something or to make you comfortable. Even Nestle is a multinational company and has huge wealth. As long as it operates in Sri Lanka, it has created enormous wealth in rupees. No matter how much money it has as of now, it has a problem of, like, it is not the Nestle's problem. Since the country has a problem of foreign exchange reserves, now even Nestle cannot make payments for its imports and for other services. So even though they have equivalent amount of rupees and go to the bank and ask, please give me dollars, they say, no, we don't have dollars. So this would be a big difficulty for ordinary investors and companies. Now, for the Nestle being a big company, in multinational company, has easily found a way out from this. Ask its related party company, give me 26.6 million. You can go to Colombo Stock Exchange website and download this announcement and read the detail. It will tell you, and nice analysis can be done. The equivalent rupee value of this thing is about 5 billion rupees. If you go further down, it gives you additional information like this. What are they going to do with this? As of now, exports and other costs recoveries. When Nestle exports goods, it gets dollars. Equivalent rupee amount is 3.2 billion. 3.2 billion. For imports and other costs payable or expenses payable, it needs 7.1 billion. 3.2, here 7.1. Say 7.2, therefore, so 7.2 minus 3.2 means 4 billion shortage is there. In dollars, now your sister company gives you dollars, which is equivalent to 5.4 billion. So you have an excess of 1.4 billion even. So this is how the company has been facilitated by its related party company, so that they can survive in the company, like in the market, under any circumstances compared to other small companies. Okay, so just to share the things, better be in touch with what's happening in the market. I'll go back to the presentation. How best then we improve the quality of information? Could be many ways. Everything has been summarized into some selected domains or dimensions. Mainly, conceptual framework says, already you have learned about, we need to always provide relevant information and faithful information. Faithful representation and relevance are the key guiding qualitative characteristics, which you have already learned. If you know that for any decision making, if you give irrelevant information, that is useless. But in the meantime, if you do not provide something relevant, that is also fundamentally wrong. And on the other hand, the relevant information provided should be faithfully represented. So in order to faithfully represent, it should be complete, it should be unbiased, neutral, that means free from errors, that means there should not be overstatements and understatements. That is why in accounting, especially when it comes to high reporting, we need to make sure that whether there is a significant overstatement or understatement. There shouldn't be. It does not mean exactly correct, because we can't make sure, or ensure that everything would be accurate to the last cent. No, we follow the materiality. So faithful presentation is there. Relevance is actually it should have predictive value, confirmatory value, and immateriality. You see, materiality is there. If it's immaterial, forget about it. It is not relevant. So this is how the characteristics of qualitative characteristics are defined. Now, enhancing characteristics. If you have achieved this, of course, it is a must. You got to do with this. You need to ensure that these characteristics have been included or protected, but further take actions to improve the basic quality by doing what? Comparable information. Why the comparability is important? Think of the going concern of a company. Limited liability company is a legal person. That person is not expected to die soon. That person is expected to run or carry out its operations for a foreseeable future time without having any problem. When we prepare the financial statements, we assume that there is a going concern, no matter how difficulties are there. Even now, many talks about Sri Lankan economy from opposition camps and sometimes extremes, and saying that, oh, tomorrow, of course, Sri Lankan economy has lots of problems as of now. Nothing to hide, it is true. But we take all these decisions, on the assumption that country will not become bankrupt, it would continue on that particular assumption. By the same way, sometimes the economy may crash, who knows? In case by January, if the government will not be able to not be able to honor the ISB, of course, it would be declared as bankrupt as far as these ISBs are concerned, only for this thing. So being a bankrupt is not a big problem, but that would be a consequence. But as of now, we do not act thinking that we will bankrupt. No, we don't. So likewise, same thing is applied when we prepare financial statements, unless we have very specific reasons to show that the cessation, the operations would be cessed, stopped, going concern would be affected, we assume that company is a going concern. So if it is a going concern, there is no end. In order to measure your performance or results, you measure them periodically, annually. So last year result, this year result, next year result of the year before last, likewise. It is a continuation, accumulation. Unless you have this comparability aspect, there is no use. That is the reason why we want to have the comparability. Verifiability. How do we verify? Then you need to have lots of information, books of accounts, proper accounting systems, likewise. Timeliness. On time, you have to provide the information, and it should be presented in an understandable manner. To great extent, general purpose financial statements provide understandable information, but if you look at the notes, explanation, accounting policies, sometimes general or the layman, ordinary person cannot understand. This is a big question. Jargons are also used. Simply speaking, if you comply with the conceptual framework, you should not play with jargons. Definitions: assets, liability, equity, income, expenses. I hope everyone knows about these things. Then I'm not going to explain one by one. You are familiar with these things, but I would like to touch upon the insight of these elements. Here there are five elements. I would like to ask you a question, maybe a poll can be raised. One minute. Okay. 1 minute. Save it. Create it. Launch it. Okay, now I launch. Even though they are like, say, we talk about 5 elements, according to your knowledge, really, how many elements are there? So how many elements are really essential for us to prepare financial statements? How many elements are really needed? Because I'm just explaining. Sometimes the question may not be clear enough for you. How many elements are really needed for us to prepare financial statements? In a rough manner. Yeah, already 177, like, but 67 have bold. Yeah. I'll give you another 30 seconds. Yeah, only 113 have replied yes. I want everyone to attempt. Only 73% has replied it. Some more to reply. Please, just no matter whether your answer is right or wrong, don't worry. Click your answer there. Reply to the poll, not here, not in the chat box. Uh, 140, 37 more. Please click any answer. Don't think too much. Just click. Still there is a kind of resistance or reluctance of showing, because even I can't trace who have answered. I know only the numbers. So if I want to know your index, so I need to check, because there's no one. No, don't worry about the accuracy of the answer that you have given. Just click your answer. Okay, still it is not completed. 146, 82%. I'll share the result with you. This is how you have responded to this particular poll. Do you see the result? %46 says we need 5 elements. Another 46% says 3. 8% says 2. 1% says 1. Okay, we will discuss. In fact, we can prepare finite statements with rough, just a bridge statement can be prepared with 2 elements. Now, the next question is, I will explain what 2 elements, what are they. Before telling you what they are, I would like to have another poll. What are they? No, 1 minute. Okay. Now I am asking, what are those two elements? Now I tell you there are two. You guess. Income and expenses. Assets and equity. Assets and liability. The last one. Income and okay. Oh, no. Sorry. Here there are no. What I have. It is not there. Okay. I'm sorry. Now there's a confusion of just creating this particular whole. Yeah, you can type the answer. What two elements are they? You can use a asset A, liability L, equity EQ, income I, expenses EX. You can type it in the chat box quickly. I say that there are only two elements. With two elements, we can prepare it. Take few minutes and do it. Okay. I think I'm getting the correct answer. So most have written the correct answer. That is asset and liabilities. I'm explaining why and how. Actually, what an entity has, which could be traced. Some of the items may be physical, some of the items may not be physical. What could be traced are only assets and liabilities. All the others are simply abstracts. So we use other three elements for the purpose of providing detailed statement, to provide a real balance sheet or real status of an entity. If you can access, if you know all the assets and liabilities of an entity, so that is the balance sheet picture. Study this very carefully. So that's the reality. Equity is nothing but the difference between asset and liabilities. Now you can derive equity. Assume that entity says, okay, at the beginning of the year, I had 5 billion. End of the year, I have 6 billion, right? So then you need to have the explanation. How 6 billion comprises of maybe 20 billion worth of assets and 14 billion of amounting to 14 billion of liabilities. 20 minus 14 becomes 6. Then again, 8 also you have the reconciliation. So simply you can say asset is this much, liability is this much, therefore the difference is equity. You may not have the detail, what I'm telling is just to have rough picture. So that is how and why, if someone has not disclosed his or her properties, wealth or income, any other thing, it is easy for the authorities to catch them if they want. So here they don't want. Simply access to the sources where they acquire assets and check the liabilities, take the difference, that is your equity. Then how about income and expenses? Actually, income and expenses are changes in assets and liabilities and nothing but. So if you go through the definition of income and expenses, you would realize increase in assets or decrease in liabilities that would give rise that gives rise to increase in equity without any contribution from or interaction with shareholders. The reversal of income is the definition for expenses. Therefore, both income and expenses are nothing but changes in assets and liabilities. That's it. Very easy. How do we recognize items? Recognition means not identification. Recognition means you catch them, grasp them, trace them, bring them into the book, recording purposes. So then you need to have relevant information about the asset or liability. All the time it talks about asset and liabilities. Recognition, asset or liability, and about any income, expenses, or changes in equity. Since we deal with all 5 elements, to give you a very detailed picture, we deal with all these elements to maintain the completeness. But to get rough idea, assets and liabilities are adequate. Then relevant information is needed and faithful representation is needed. Then we record them and recognize them in the financial statement. Recognition cannot be done without having a measurement base. Conceptual framework talks about 2 types of bases. Number 1 is the historical cost. The other one is current value. That means the today's value. Today's value. Historical cost, everyone knows about it. Why it is called historical? Because for each and every item, cost is defined. For instance, when it comes to inventory, how do you ascertain the cost of inventory? LKS 2 does not talk about historical cost. It talks about the cost. What is the cost of inventory? It explains maybe the purchase price, transportation of the factory, any other charges, levies, or whatever. Just bringing the inventories to its present condition and location. There are some provisions. You can read them later. In that process, you calculate the cost. Assume that you did it today, 28th October. By tomorrow, that is 29th October, today's cost becomes automatically historical. Not even you need not to wait for 1 day. Once you have done the transaction, things become historical. That is why. Current value means, so if you want to deal with given item, asset and liability, what's the current value? Maybe current market price or any other thing. Different tools can be used. Whatever the tools that you use, finally we ascertain the current value. Under the current value, conceptual framework has referred to four different value dimension. Number one is the fair value. We will be learning fair value later on. In simple terms, if you want to understand what a fair value is the most efficient competitive market price. Again, most competitive and efficient market price. In theory, the fair value is exactly equivalent to the equilibrium price of a product in a perfectly competitive market. ආර්ථික විද්‍යාවේ ඉගෙනගෙන තියෙන පූර්ණ තරඟකාරී වෙළඳපොළක තියෙන equilibrium price එක තමයි සාධාරණ මිල සාධාරණ වටිනා අගය කියලා කියන්නේ. දැන් ඒක උගත වැඩිපුර ඉගෙනගෙන අධ්‍යයනය කරගන්න. So that is the idea. But do you see such a perfectly competitive market? No way. Instead, you see oligarchies and monopolies. So even in our marketplaces, it's very hard for us to find a fair value, even though we refer to some market prices. Always think of the limitations. It's all right. Number two, value in use. Value in use deals with assets. Assume that there is a computer. Now I am using this particular computer. Computer could be used for many applications and many things. There could be general purposes, any other uses we do not know. If I have just bought for this by paying 200,000, this is the current market price is 200,000. I may say that that could be the fair value, or it would be the historical cost. But maybe by tomorrow or day after tomorrow, I might get an opportunity of just doing something. Assume that I have some expertise in IT and technology. I would like to join a cryptocurrency mining business, right? From tomorrow onwards, I fully engage with this mining business. Assume that it's not on an assumption. If that mining helps me to earn some money, say $100 per month, and I'm sure that I can use this computer for 5 years, then you can forecast your expected future cash flows. So I'm not going to use this computer for anything. My intention is, that is my use. I'm going to use it for mining, for cryptocurrency, for 5 years. Machine is pretty much fit for that purpose, whatever. Then you can 100 into 10, 36 or 60 months, 6,000 US dollars. Then you discount them and ascertain the present value. That is what we call value in use. Therefore, value in use may vary depending on the use. What are you going to do? If you use it for general purposes, no point of, because you can't ascertain the value of this particular computer. In my example now, I am using it for teaching. From that, some part of this value may be connected with my salary, but I can't say that my entire salary is connected to use of this particular computer. No. So when I do my job, I use it, but the value in use cannot be specifically identified. But in the case of mining, cryptocurrencies, yes, value in use is there. I hope message is clear. Fulfillment value is to deal with liabilities. when you have to settle something with obligation, so that is the fulfillment value. For example, say Express Pearl ship has done lots of damages to environment. In their balance sheet now, say roughly they estimated the cost, saying that to make good this environmental impact, cost would be say 500 million US dollars. But towards the end, when the litigation continues and due to the social pressures and all these things, now in like the court might take into account all these aspects and say that no, so compensation is not adequate, you need to do these things, these things. Therefore, in order to fulfill this obligation, cost would be 800 million, not 500. So the fulfillment value may change, or sometimes court might order you do this thing without specifying an amount. So by the time you do it, the value may be different from the value estimated. Therefore, mind that value in use deals with or refers to assets, fulfillment value refers to liabilities. Current cost deals with replacement cost, net realizable value, or whatever. If you want to replace or acquire something with the current market price, that is what we call current cost. There are some items that you have to recognize at the current cost. For example, when it comes to inventory valuation, cost is ascertained on the one hand, but on the other hand, you need to check the realizable value as well by referring to the current market price, something like you know how to calculate net realizable value. But I just told you broad areas. So these are the concepts. Based on these concepts, specific accounting standards can specify, okay, do that, do this, so you can value like this. Actually, those recommendations, provisions given in accounting standards are in line with these value bases. For example, LKS 2 talks about net realizable value. Net realizable value refers to nothing else but the current cost. Regulatory framework for financial reporting in Sri Lanka. We have acts and other regulation, corporate governance requirements as well. We'll have a look what they are. Everyone knows, then these things I can quickly run through. Accounting and Auditing Standard Act. It is a part and parcel of the law of our country. Everyone knows that. That is what you can't prepare financial statement of a limited liability company without complying these acts. Otherwise, that would be a violation. It is an offense if you do so. Companies Act number.
Excuse me, sir. We can't see the slides.
Sorry.
Excuse me, sir. We can't see the slides.
I'm so sorry. I was under the impression that, okay, sorry that I have not shared. Now, do you see them?
Yes, sir.
Okay,
thank you so much.
Okay, I'm so sorry for the mistake. Yeah, so sometimes I do not see the chat box. Good that you talk. Now only I saw the messages. Okay. Yeah, these are the things I referred to. Measurement basis, fair value, value in use, fulfillment value, and current cost. Value in use refers to assets, fulfillment value use refers to liabilities, and current cost. Acts and other regulations and governance requirements. So these are the acts. Need not to by heart. Roughly, everyone has some idea. Of course, Accounting and Auditing Standard Act has a relevance. Companies Act, Finance Act 2021, the recently enacted one I just told you. Securities and Exchange Commission Act of 1987. This was also amended in July 2021. Actually, it should be 2021. It was amended. Lots of discussions are going on about this Securities and Exchange Commission Act. I advise you guys to read the amendments to these two acts. I had the copy number. So you can even download it from the internet. Revised Finance Act is very small. It contains only 19 or 20 small pages. But the Securities and Exchange Commission Act, the revised one, is big. Okay, someone asked a question again. So could you explain what is the difference between fair value and current cost? Okay, good question. Again, is that clear to you, the fair value? I'll just go back. Okay, fair value. So your question is about current cost. Fair value and the current cost. So current value is anything, any value taken by referring to the present status, present condition. That is why it is called current value. Current value can be reflected in 4 different dimensions. Number 1 is the fair value, but the word fair is ambiguous and vague, but fair. So how do you define? Very difficult. That is why I told you the fair value. The very good example for the fair value is the equilibrium price, which is determined in a perfectly competitive market. There can't be any other fair value in this world. But unfortunately, there are no perfectly competitive markets. That means there are no fair values, even though you calculate it. Right? So then you need to go for some alternative, best available information. So some kind of competitive market or efficient market or maybe independent market prices can be taken as the fair value. That is what we call a proxy. Real fair value cannot be obtained. Instead, you take some proxies. One of the proxies is to take the market. For example, what is the fair value of a second-hand motor vehicle? So you can refer it. You can refer to some experts and get that value. So is it connected? Is the connection there? Hello. So there is a power failure here.